Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're going to be discussing current markets, a bit of our outlook going forward, and we'll be diving into some risk mitigation strategies to manage the downside if you're a little bit more of a risk-adverse investor, worried about current markets, or maybe you're a retiree looking to lower the overall volatility in your portfolio. So we're going to be taking a closer look at BMO's new buffer ETFs that we've been bringing to market over the past, 6 months now, 6 to 9 months. But before we get started, a quick reminder that today we are not providing you investment advice or recommendations. Today's episode is all about providing education to Canadian DIY investors. And with me today, I have my colleague Chris McCaney, Director, Portfolio Manager with BMO ETFs. He is responsible for our options or derivative-based strategies here on the desk. So Chris, welcome back to the channel. Thanks for joining us.
Thank you, Erin. Happy to be here.
All right. Well, I want to just sort of dive in and give a bit of an overview in terms of what we're seeing in the markets right now. And I think we're going to take a closer look at the S&P 500, but walk us through what's happened so far this year.
Yeah, I mean, really, I think this year has been a continuation of what we've seen since kind of that end of Q3 2022. Of course, we had that big market sell-off that year with interest rates rising. And kind of around October 2022 was the market low. And we've really been rallying since then. You know, we did have a little bit of a setback in 2023 as well. But the market has rallied on the back of the fact that the economy continues to stay strong, particularly in the U.S. We entered this year with the market expecting that there would be 6 or maybe even 7 rate cuts due to economic slowdown and needing to re-stimulate the economy. But we really haven't seen that play out at all. And in fact, now markets are only pricing in about 1, if any, rate cuts this year. Again, simply because the economy has been so strong, even in the face of these higher interest rates. And so we've seen the market really reflect that as well with fairly strong results so far here in 2024.
A lot of which has been driven by that magnificent 7, right? So a concentrated amount of stocks in there driving a lot of
absolutely.
growth.
In particular, NVIDIA is one that I think investors have really been talking about this year with the move to AI. So many companies making this push to that AI arena, and NVIDIA really being the leader there in terms of the chips that they produce. And so, yeah, you've really seen this concentration at the top of the market. I think we're really at multi-decade highs in terms of the amount of exposure those top 5 to 10 companies take up in the index.
For sure. And we did see that recent pullback. Do you think this is a sign of a larger correction to come?
Yeah, I think, unfortunately for investors, the news is it's hard to tell, right? We have seen, as I said, the market rally to start 2024. The last month or so, as you say, we have sold off a little bit. We're going through earnings season, which is somewhat mixed right now in terms of the results that we're seeing and in terms of the stock performance after those results. And it's really mixed within sectors as well. So we're starting to see a bit of this divergence. Maybe it's those higher interest rates, really starting to take hold in the economy. But we're seeing a bit of a sell-off here in the last few weeks as investors understand that interest rates are going to stay higher for longer. There's kind of this double-edged sword. We say the economy has been strong and therefore rates need to stay high. But of course, that also chokes off a little bit of further growth potential for companies. And so we're starting to see stock prices come off and soften just a little bit in reflection of that. But, I think we certainly could see this trend continue. We could see that continue going forward as again, these higher interest rates are really only starting to take hold in the economy, and we're starting to feel the effects now.
What about overall volatility? Because we are in a U.S. election year and a record election year around the globe. But if we look at the VIX, like generally speaking, what are we seeing with volatility and what can we expect this year?
I think, really since we've moved to this new regime with higher interest rates and the non-zero interest rate policy, that equity market volatility and the VIX, as you mentioned, are really just staying more elevated than they were in the past. I think kind of the low point now is when the VIX gets to 15. That's really kind of the bottom that we're seeing, and it'll jump at, once it gets to those levels. So we don't see that calmness in equity markets that we've seen over the last few years. And on the other side of things, on the interest rate side and the fixed income side of the portfolio, that the volatility of that part of the market has continued to stay high as well. I think that zero interest rate policy of the past really suppressed fixed income volatility in general. And now we're seeing that move to more normalized levels, which is actually higher than where it has been for a long time. And so any investor that's this sort of balanced investor that has some element of equity, some element of fixed income, the overall risk of that portfolio is continuing to go up over time as we're in this sort of new regime of, a little bit more uncertainty as to where markets are going to go, but also where interest rates are going to go as a result of that. So overall volatility being introduced into clients' portfolios.
I know we're covering off a lot of risks and this is sounding a little doom and gloomy, but let's talk about the last one here, inflation risk, because you've covered off sort of the interest rate policy outlook. But what about inflation risk in the portfolio?
Yeah, I think this is the big unknown for investors and for even central banks, right? I think they've done a good job getting inflation down from those really high extreme levels that we saw, those 6, 7, 8% inflation numbers that we've seen the past couple of years. Central banks have done a good job reining that in, and we're back down to more normalized levels. And, it does depend if you're looking in Canada versus the US as well, but we are seeing inflation starting to calm down. But central banks continue to state that this 2% continues to be their target for inflation, and we're just not getting there yet, particularly in the US, still around that 3+%. And so I think this last mile, so to speak, in terms of getting that inflation, not down from 6 to 3, but from 3 back down to 2, could be the more challenging part for central banks, as it's hard for them to control everything. But I think their messaging is we're going to keep interest rates where they are. We're going to keep them higher for longer until we're comfortable that inflation is heading back down to that 2% level. Maybe I'll just go back to your last question, actually, because you mentioned elections. I didn't really touch on that, but not just in the US, but globally, as you say, a big year for elections, and volatility has already increased around those dates. Similar to the futures market for equities, there's a futures market for volatility as well. And if you look at the volatility that's being priced around that November timeframe when that US election does occur, it's already relatively higher than what we've seen in previous years. So the market is expecting it to become even more volatile than what we're seeing right now.
We're going to dig in a little bit more to that on Spring into ETFs. We're going to talk in depth about investing in a US election year and what we've seen historically and what that means for markets. But I think, as an ETF issuer, we kind of have a unique view on things, and we've seen tons of investors pouring money into cash and, putting money on the sidelines. To us, it seems like these people are very scared of what's happening in the markets right now. I'm curious to our viewers, comment below. Let us know what you're thinking. Are you bullish or bearish on the markets right now, or what's your sentiment? Very curious to hear that. So we'll drop that in the comments. But Chris, aside from cash, what are some other strategies that investors can use to protect themselves while staying invested?
Yeah, I think that's the goal too, is to stay invested, right? As you say, it is kind of interesting times, and investors could be scared off of that. And cash has been a good place to hide, actually. You're getting 5+% from money markets or from very short-term fixed income instruments. And so that's been a good place for investors to be if they have been a little bit nervous about the markets. But, as we're going forward, I mentioned several rate cuts were priced in for this year and is not happening. But over time, we will see those short-term rates start to come down again. And so investors do need to think about, how do I take all this cash that's in money market or sitting on the sidelines and earning me this nice yield so far? how am I going to redeploy that back into my portfolio in a risk aware way? And I think it's not just buying equities and bonds anymore. Investors used to be able to count on the fixed income part of their portfolio, being a nice balance to equity risk. And if equity sold off, fixed income would rally. And that was a nice risk mitigation tool. But what we've seen over the last few years, and again, since interest rates have moved off the zero interest rate policy, that doesn't necessarily work anymore. Fixed income and equities are more positively correlated than they have been in the past. And so I think investors need to just introduce different sources of return potential into their portfolio outside of just pure fixed income or pure equities, an allocation to alternative strategies or to gold or precious metals. A lot of investors talk about Bitcoin being the new gold, something that's returns are driven not by the same things that equity returns are driven by. So whether that is, again, adding alternatives, adding gold, or taking into account newer strategies like we're talking about today with buffers, an explicit type of risk control in the portfolio beyond just I'll buy equities and fixed income and hope that they balance each other out.
Well, we've been pretty active launching new solutions to really give investors the tools around this. So we just launched ZGLD, our BMO Gold Bullion ETF. And as I mentioned, buffers. So I do want to get into buffers. We introduced these. You came on, I think it was in November. We did sort of a deep dive into buffer ETFs. So if you want that full deep dive, go watch that video. But I do want to do a quick review and a reintroduction of this structure to our listeners. So how does a buffer work?
Sure. Yeah. And, there's really kind of 3 steps to building a buffer portfolio or a buffer ETF. And really what you start with is the underlying investment, that underlying asset you want exposure to. And so for us in BMO's suite of buffer ETFs, we use ZUE is the ticker. That's the BMO S&P 500 hedge to CAD index ETF. So you're getting exposure to the S&P 500, and that's the base of the portfolio. So that's step 1. From there, we add on an option overlay to create this layer of protection. And for BMO's ETFs, that's a 15% protection over a 1-year time period. So I'm going to go out and buy a put option, which creates this downside protection. It's a 1-year option. And then I'm going to sell another option that's 15%, the strike price is 15% lower than where the market is. And so that creates this buffer zone of this first 15% of losses that investors will be protected against over the course of this 1-year period. Now, there's a cost to adding this protection into the portfolio. And so the third step involves selling an upside call option to fund the cost of this protective put spread. Now, covered call investors would be familiar with that. Selling a call option trades away some of that upside potential and creates income in the portfolio, right? Except for in the case of buffers, we're not distributing that income. We're using it to pay for this downside protection. And so investors will have a cap on the upside return potential that they have in return for getting this 15% downside protection. Now, the one other thing that's kind of unique of buffer ETFs is that this structure will be in place for 1 year. So, we go out and buy at the end of September for ZOCT, the ZOCT. On the last day of September, we put that protection in place and we'll hold it for the whole calendar year. So investors can know within that year, depending on where markets have moved, how much protection do I have left? How much room do I have to the cap? And of course, we provide all that data on our website as well.
Yeah, I think having that series of options available for investors with us coming out with them every 3 months is really beneficial as well. So really great option for those investors who like the S&P 500, who want to stay invested in it, but are more risk adverse. It comes back to that whole behavioral aspect of investor psychology. It's very hard to time the market. We know that. We also know that, if we're investing for the long term, that we should be, looking at history, invested in the market, but emotions can cause investors to do some crazy things. Yeah. A few ways you can use these ETFs in a portfolio. Let's walk through a couple strategies investors could employ.
Yeah, and I think you kind of alluded to this a little bit. If an investor has that, equity exposure right now, let's say it's, the S&P 500 or something similar within their portfolio, but want to dial down that risk a little bit. We've been talking about how volatility has just picked up in general and is expected to continue. If you want to avoid some of that volatility, simply take a portion of that portfolio that's allocated to US equities and put a buffer ETF in there. As you say, that maintains your growth potential, that keeps you in the market. So if markets do keep going up, you get some of that benefit. But it also dampens the overall volatility of your portfolio. And should markets sell off, you would be protected against that. So depending on your level of risk aversion, that will dictate how much buffer ETFs you add into that equity allocation. You know, if you're more risk averse, you're going to have a higher allocation to buffers. If you're less risk averse, you want that full growth potential, you're okay with the volatility, you would have less allocation to those buffers. So that's kind of the strategic allocation. Of course, investors could be very tactical with these as well on a very short-term basis. Again, should you think the market is going to take a turn, some of these might look very attractive to you in the sense that you have a strong amount of downside protection from where the market currently is, and still some of that upside potential in case you're wrong. So on a tactical basis, if you're taking a short-term view, markets are going to go down from here, but if I'm wrong, I want to stay invested, that's a great way to use a buffer ETF as well. And then I'll also just mention, because these are one-year outcome periods, as you move through that period in the market, oscillates up and down. As you get towards the end of the outcome period, you can take a look at some of these buffer ETFs that can provide a very compelling return potential with very, very little risk left in them. Again, depending on how the market has moved up to that point. So that's a kind of a third way investors can look at using these.
That's great. Thanks. So we've seen a lot of success in these down in the US with innovator ETFs, but we've come out with a full series of solutions for Canadian investors. We have a ton of options capabilities. We've proven that with our covered call strategies, but what makes our strategies unique in the marketplace?
Yeah, and I think the way I like to think about our buffer ETFs is really the similar philosophy across our whole ETF lineup. BMO, obviously a Canadian bank, major player in the Canadian ETF landscape. BMO builds solutions for Canadian investors. And so, you can have comfort that if you are a Canadian investor and you're looking for an exposure, that BMO is building it in the right way for Canadian investors. There's different elements to how these portfolios are built. You mentioned Innovator, and there are others in the US as well doing this down south. They use a different structure that generally is fully synthetic structure. That doesn't work as well for Canadian investors from a tax perspective. And so, again, taking the lens that we want to build these for Canadian investors, whatever their needs are, whether that's tax or otherwise, we want to have a lower cost solution for Canadians that goes out and builds the portfolio the right way. So, I mentioned down south, they have a fully synthetic structure. I mentioned the way we build ours is the first thing we do is we go out and buy that asset itself. So we're going out and buying the S&P 500 directly. We're collecting dividends on top of that as well as a result. And so one thing I would mention is that when you ever see us referring to price caps or things like that, that's always only the price return. You're getting dividends over and above that as well. So just something else for investors to keep in mind. And again, just the idea that when we approach building our ETFs and providing them out there in Canada, we're doing it from a Canadian lens and a Canadian investor's perspective.
All right. And I know you mentioned it, but I did just want to highlight again, just the level of transparency that we provide. And I'm showing exactly where on our website you can click on the PDF to find out an updated view on the remaining outcome period, on the remaining cap or the remaining downside buffer. So just giving you that level of transparency to really make the decision, especially if you're using these things a little bit more tactically, as you mentioned, buying them out in the term, then this is a really handy tool. You mentioned with buffer ETFs, we have that 1 year outcome period. So you're buying at day one, 1 year later, but walk us through the potential outcome scenarios, looking at different market performance situations and how this could look for an investor at the end of the day.
Yeah, and I think, this really creates an added level of transparency for investors to know, okay, if I make this investment and I hold this 1 year from now, what is my portfolio going to look like? You really have an extra level of insight here as to how your investment can perform. And so if we think about, the ups and downs, what are the different scenarios over this 1 year period that can actually happen? Let's start with, a negative period. Let's say markets are down significantly, 20, 30%, let's call it even 40%. The S&P 500 is down 1 year from now. Well, I mentioned our buffer ETFs provide this protection against the first 15% of losses. And so if the market is down 40%, the buffer ETF would be down approximately 25 because that first 15% was protected and you'd be down the remainder. So that's kind of the worst case scenario. That would be great if you were in a buffer ETF, but of course you don't want to lose any money. But that would be kind of the worst case scenario you would get out of one of these strategies. Now let's consider a scenario where there's a mild down market. So somewhere between 0 and that 15% level of protection that we provide. If the market is down 10, for example, then the buffer ETF investor can expect to be down about 0. They should be about flat because, again, that first 15% is protected. So anywhere from that 0 to 15 negative, buffer ETF investor should come out about flat. Now, in the third scenario where markets are, let's just say, up mildly or up a small amount, call it high single digits or in the single digit range, a buffer ETF should provide that 1-for-1 upside. So again, maintaining that growth potential from the markets up to wherever that cap level is set. Let's say, for example, 10% is the cap. You will experience that 1-for-1 upside up to wherever that cap is. And then the fourth scenario is in a very strong bull market where the S&P 500 or the market returns a very strong return above wherever that cap is set on that buffer ETF. That buffer investor would be capped out at that 10% or whatever the applicable cap is for that ETF at that time. So, really that's the one scenario where a buffer ETF investor, quote unquote, would lose, is giving up that extra return potential. But again, I think a lot of risk averse investors are willing to give up that higher level of return in order for that downside protection, in order for that cushion to dampen overall volatility.
Awesome. Okay. Well, thanks, Chris. Thanks for all your insights around the markets, the reintroduction of buffer ETFs. I like how we covered off all the different strategies and ways to use these products as an insurance policy in your portfolio. So thanks for joining me. Next week, we will be introducing the first in a new quarterly series that we're calling Breakfast with Bamber. So Bill Bamber is our CEO of BMO Global Asset Management, and each quarter he's going to bring on a different guest, each with a different expertise levels and areas of expertise. Next week, we're going to be starting with Colonel Cedric Layton, who you might recognize from CNN. He's had a 26-year career as an intelligence officer in the U.S. Army. So we're going to be diving into some of the geopolitical risks and activities that are going on around the globe. And Bill will be interviewing Colonel Layton and bringing the discussion back to your investment portfolio and ETF ideas to consider. So we'll hope you join us for this series. We will see you next week. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.